Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Yeah, it was quite interesting. Now, when it got to the eventual bottom, 3,150 points. Look, I can't remember exactly where it was 1 month later, but it had pushed up really hard. It had grown quite a bit off that bottom.
Yeah,
and that's what tends to happen. And what you're really seeing there is you're seeing that fear to get out becomes fear to get in right now. I guess at any point in time, you've got X amount of people that are looking to buy and you've got X amount of people that are looking to sell. Now, in normal conditions, the buyers and the sellers match up. What you have when people are panicking is that you have a mismatch there. So you have so much supply and very little demand. People are selling, they're panicking, the price keeps dropping because no one wants to buy. Everyone's waiting for what they think is the bottom. And then all of a sudden, a huge group of people panic and they panic out and they sell. The saying is when the last person has panicked out, that things turn around and start to head north then, which is I guess a simple but a true analogy. And then all that money that was waiting on the sidelines to come in and buy for a discount where people are hoping to get into the bottom, they suddenly start to panic and realise that
they're going to miss out.
Hey, I think we've missed the bottom here. So you get that flip around then, and you get demand exceeding supply. Because if you were going to panic and all of a sudden you see what you think was the bottom and then the prices jumped by 10 or 15% up, all of a sudden you're thinking, okay, I'm going to hang off. I'm not going to panic anymore. And then you've got all this money on the sidelines that's been waiting to come in. And all of a sudden those people realise, hey, we've missed the bottom. We can still get in for 15% down there. And then they start to move in and the price starts to head north again. So,
but that's
extreme conditions.
I think that's why I want to talk about this, because I think it's fascinating it's very easy to look backwards at the graph and go, oh yeah, that was the top, this was the bottom, and that's kind of what happened there. Oh yeah, it dropped by 15% that 1 week. But you go, the actual lived experience is very different, because you're just going, it's not, you weren't at the bottom of that when you had that 15% drop in 1 week. Like we said the other day, no one rings a bell at the bottom and says, all right, that's it. It's all over now. It's going to go up from here. So you have that drop, and then you also have you're sort of sitting there waiting, hoping things don't get worse. So it's not, and then very quickly you have that rebound, and it goes from a fear that things are going to get worse to a fear that, oh geez, if I have panicked and sold, I've missed out here. I've got to rush to get back in. And
that's right. Yeah.
Is that what was there people then a month after that bottom when things had rebounded really quickly? Were there people that had panicked that were now trying to rush and get back in?
There were, and look, there were along the way as well, because I guess it never heads straight down and straight back up. There's all these little rallies, and then there's it'll drop. This last week, for example.
Well, that's what I was about to say. We're seeing that now, aren't we?
We're seeing that now. So basically, Thursday of last week, it was the 23rd of March, the ASX 200 reached 4,613 points. So we could say that's 36% down from its previous high of 7,162 points. This week, or since then, it's rallied. It's picked back up 6% of that. So we're currently down only 30%. So look, it's very, very hard. If you just think of that, just this last week was fresh in everyone's mind. Now I say this last week, we're recording this on the 3rd 3rd of April.
Yeah.
So it's interesting, isn't it? Because was that the bottom?
Yeah.
Was the 23rd of March? Was that the bottom, or is that what they refer to as a dead cat bouncing? Is that a dead cat bouncing? So
I love the phrase "dead cat bounce." Do you know what it means?
Yeah. If you drop
if you drop anything will bounce if you drop it from high enough. So you drop a dead cat from high enough, and it's still going to bounce and look like it's alive, which is a pretty horrific imagery. But it's a but that's I guess the point is when you're living through this and then comparing it to something that you've been through previously, you go, in hindsight, when you go, okay, that was the bottom. If someone had said on Friday last week, or whenever we were 36% down, if someone said, if you could say to people, hey, it's okay, don't panic, this is the bottom, it's all uphill from here, it would be a lot easier. But the reality, and this is kind of what I'm saying, you can't, you're saying to people, you have to not panic because we need to stay invested for the long term. We need to be a part of this recovery, and you need to stay invested as this recovers. But I don't know whether we're at the bottom now, and I don't know when that will come. It might be the bottom now, or it might be in 6 months' time. It might, we don't know that. It's a hard thing to experience without having the hindsight to be able to look back and go, oh, it's all good. It all worked out in the end.
Yeah. So I remember, so going back to the global financial crisis, that fall of 57%, that didn't happen all at once, of course.
Yeah.
It fell 15%. It regained 5%. It fell. 10%. It regained 5%. It fell. It stayed there for a while. It fell 14% in 1 week. From memory, it recovered a little bit the week after.
Yeah.
It fell again. So recognise that, I guess, on March 9, 2009, when it had fallen 57% in Australia, in America, and Europe, people were thinking, hey, it's got further to go. When it rallied the week after, it pushed up hard the week after, it regained, and people thought, hey, it's another dead cat bounce.
Yeah.
So, and then all of a sudden it took off. Yeah. We still weren't sure if that was the absolute bottom, of course, and no one would ever know. It's only months or even years later before you can say, okay, that was the bottom.
Yeah.
I remember thinking there wasn't a great panic for people to get back in at that point in time. No. There were people that were looking to get back in.
But and this is again what probably happens is that, it's probably not a month later. It's if you look at what's happened since then. So from that very bottom, so the next 10 years, returns were on average, say 12, 13%. But it seems
so if you look at the American markets, and if you recall way back at the start of this episode, we talked about how when I first started the industry, it was 2001, and the American markets had suffered a big loss in 1999, 2000 with the .com bust, and our Australian companies hadn't suffered at all, so they didn't drop much at all. Yeah, there became a bit of a disconnect, and while Australian shares were really pushing up hard in 2004, 5, 6, and 7, America was really just getting back to where they had come. From 1999. So, what had happened at that stage? If you look at their top 500 companies, they were going into the global financial crisis. They were at about 1,500 points, so about 15. If we call that, let's call it $15 a share. What had happened? What had happened is, let's call it $1,500 a share. 15. What had happened is that they had fallen then to 676 points from memory at the bottom of the global financial crisis, so about $676 per share. What had happened since then? So from that bottom of 676 to fast forward to this year, February of this year, they had actually grown from $676 per share to $3,400 per share. So they'd really, really rallied up over that period of time. So
quadrupled over that time.
Quadrupled over that period of time. So, and so the danger is that there were still people waiting. Yeah. There were people that sold out at $676 a share.
Yeah.
And never got back in because they were waiting for the next drop. Yeah. And they waited and they waited and they waited and things went up and up and up and up and up.
Yeah.
So I guess, we always go back to, you just can't predict what's going to happen. And our advice to people is to pick your strategy, and just stick to it, even when there is this volatility.
Yeah. It's obviously been, I mean, like we said, these cycles are a normal part of things, and you see people doing a similar thing after every cycle. And I read an interesting thing about this a couple of years ago. It was talking about the difference between people's perception of investment market returns over the last 10 years and the reality. And that big drop was, had obviously burnt so many people, and it had been, really burnt into their psyche as to how bad that was. So that, you had years where, I think it was a US company thing. So similar, there'd been a year where US companies had, grown, the price had gone up by 30%. And they were basically interviewing the average investor, or the average person in the street, saying what happened in the share market this year. And they thought that it had dropped for that year. That was still so in that fear sort of part of the cycle, that they were so worried that the market was going to drop that just didn't line up with the reality of what was happening coming out of the bottom of that GFC. It was, things were jumping ahead in terms of share prices, but it just didn't feel like that to most people.
Yeah, look, I can certainly appreciate that. So in 2004, 5, 6, and 7, I remember people talking about their investments all the time, and I remember a lot of people had become day traders, all of these types of things.
Yeah,
it seems to be on the front of everyone's mind now. If you look at what's happened since the bottom of the global financial crisis, it's been a lot higher than those years of 2004, 5, and 6 in the American markets in particular. But also in the Australian market, it's been very good. So, I just haven't heard the talk at all about this. The saying is, it's been the most unloved bull market ever, and I can appreciate that because there's been very little talk about how well that's done. And I remember seeing those same studies that you mentioned just before. Where things had gone up by 30% in 1 year, but the perception was that they'd actually had a really bad year. So look, it's one of those things that I think has, for the last decade, had burned a lasting impression on a lot of people's minds, was the global financial crisis.
And that's, I think, not only is there if you look at the effect on the average person who's potentially invested through the GFC and panicked and sold, when things had dropped, you've kind of got a twofold effect of, not only have they had that drop, so if they had their $500,000 and it grew to $1 million and then it dropped to 500,000 and they panicked and sold, not only do they have that kick in the guts of feeling as though, oh, geez, I've lost that 500,000, but they've really learnt, it's really kicked them so hard that they're now probably scared to get back in. And so not only have they sort of had that drop, but they have now missed out on all those returns over the last 10 years and potentially any returns moving forward. Someone who has that experience, it's very hard to then say, hey, look, I know you had a bad experience, but over the next 30 years of your retirement, you probably need to have some money invested in companies because you need that long-term growth. It's not going to happen.
Yeah, look, absolutely.
So I think that's probably a good recap for most people of sort of what you experienced along that way. So I guess, what would you say that your main lessons learnt through all that were?
Certainly. So the lessons learned were pick a strategy and stick to it. Don't overextend yourself. So the borrowing to invest works with the right levels. And I'm a borrower now to invest because I'm still young enough to benefit from that. What happened to me and what I saw a lot of people do at that point in time, was to overextend themselves. So to over extrapolate what income they were earning, how good things were going, and say, okay, well, let's really overextend ourselves at that point in time. So like I said, I did that and didn't leave any powder dry. So when I was going to start Lighthouse, I had to actually voluntarily. Now, it was voluntarily. I had to sell those companies for a loss at that point in time because I knew that I wouldn't have the income for a good few years until the business actually got up and running. So look, it's good to keep some powder dry. Sticking to a strategy. So for most of their clients, they're taking advantage of tax deductions through salary sacrifice into their superannuation. And look, by its very nature, it's a really safe way to invest because people get paid fortnightly or they get paid weekly. What it means is that they're actually adding in money on a regular basis. So they're avoiding putting too much in at what could be a peak. They're drip feeding money in. Sticking to that strategy definitely works. It definitely works. It's one of those things that does work. And look, this time is never different. So the catalyst for this drop, we haven't seen before, or we haven't seen for quite some time. But look, economies I guess economies and companies are very, very resilient and diverse, and they always recover. So it will get to a bottom. It will turn. No one will know that. No one will ring a bell. What we know is that when human beings get involved in trying to guess that, the majority of people make the worst possible decision at the worst possible time.
And that's I guess a good the point you make there of make sure you have a plan, make sure you stick to the plan, and if your plan doesn't involve what do I do when markets drop by 30-40%, if you don't have that as part of your plan, you don't have a plan, because as you said, we know these cycles are a completely normal part of things. We know they're going to happen again and again. As we said the other day, no one could have ever predicted that someone would eat a bat in China, and that would be the thing that caused this drop. But we know that at some stage there's going to be something that causes that drop. So if you have a plan that doesn't allow for that, then you don't really have a plan. You just have something that you're hoping for things to go up and up and up. So I think that's right. That's a good one to bear in mind.
Absolutely. And can I just say I feel exhausted after all
this.
I feel like I've been
like a therapy session.
I feel like I've been lying on the couch in a therapist's office and unloading everything.
As you said, the good thing here is that all the lessons learned, all the late nights and the pain and the heartache of the GFC for yourself and clients and things learned and all the rest of it. The great thing is now the people that get to listen to this just get the benefit of that wisdom without having to go through the pain themselves.
Look,
thanks a lot, mate.
Look, no one likes what's happening now, but things will definitely recover and get back on track with absolute certainty, as they have every time throughout history. No one knows when that will be, and it feels, every week feels long for people, and I can appreciate that because they don't know when things are going to stop and turn around or what's going to happen. But certainly it will. Just hang in there.
Thank you very much for listening.
Thanks, guys.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.